Hello everybody, this is Haigh with Haigh today, and today I'm going to go over the banking crisis, what the differences are between 2008 and now. Stay tuned. Alright, so there's a lot of scuttlebutt out there, there's a lot of talk, there's a lot of media, there's a lot of FOMO. It's not fear of missing out, it's just fear and discouragement and despair and a lot of uncertainty that's happening out the market. And what I want to do is add a little bit of texture into this, a little bit of context, so we can kind of compare it to the last crisis and see if there are any correlations between the last crisis and this crisis. The difference with this right now, this is a situation where it's not a lending situation. This is an interest rate situation, and I don't want to get too in depth with the long-term interest rate versus the short-term interest rate, but it has a lot to do with this. It has a lot to do with these banks were leveraging money and they were making basically bets on low interest. And then the interest, as we all know, the Fed came in and stepped up the interest rates. We don't need to get too deep into that, but the Fed started stepping up interest rates, and what happened is that the treasuries that were held by these banks that were low or lower interest rate loans for a long term, and then the interest rates went so high that basically their books got out of whack. Then somebody sounded an alarm on Twitter, and there was basically a run on these banks. Now, a run on the bank basically is people go in and they want their money. If anybody understands about fractional reserve lending, banks don't actually hold the amount of deposits in their bank that are actually for the public. Just so you guys know, you basically, when you put your money with a bank, at the end of the day, you're loaning it to the bank. Now, it's all covered by FDIC up to $250,000. So if you're under $250,000, you should be good, even if you're in one of these lower tier banks. You talk about the top four banks: Wells Fargo, Chase, Bank of America, and Citi. Those are the top four. And then you got Goldman Sachs kind of comes in there as number 5 as well. But ultimately, the lower tier banks, the First Citizens out there and First Republics and the Signature and SVB Bank, these are kind of second tier banks. They're very solid banks. They have billions of dollars in assets, and they're actually fiscally sound. They did not make bad loans. That's the difference here. We are not talking about bad loans. We're basically talking about depositors' money. And I know that may sound a little scary to you, but basically the Fed has come in and said that they're going to backstop these banks. So at the end of the day, I really don't think that right now, as long as there isn't some kind of black swan where there's a big run on these banks and these banks go bust, that's going to be a different story. But the Fed has basically said that they're going to backstop these banks. So I think that there's a very, very strong distinction that we need to make here. This is not a real estate thing. This is a deposit thing. This is not a loan thing. This is a deposit thing. And so I think it's really important to understand that difference. So talk to your financial advisor about this. Say, hey, how's my bank looking and so forth. I'm not a financial advisor. I'm not telling you whether you should keep your money in a bank or not. But what I'm trying to do here is let you know that right now, if you saw my last report here, that the real estate market here has actually rebounded considerably well due to this crisis. And we are actually, as a macro picture, in a seller's market right here. We went down to 2.9 months of inventory for the aggregate of properties out there. Now, at the end of the day, I can't tell you what's going to come tomorrow. All I can tell you is what's right now. And right now, the real estate market looks incredibly healthy. And it looks like at the end of the day, we are not going to have even remotely close to what happened in 2008. So I hope this was helpful in letting you know that there's a big distinction here. This is a depositor thing. This is not a lending thing. And the Fed really came in very quickly. SVB Bank went down on a Friday. They came in over the weekend and said, we are going to shore up your deposits so those people are not going to lose their money. So there's no need to go and take your $250,000 out of the bank and put it under the mattress. So I hope this is helpful. Till the next time, my name is Haigh with Haigh today. If there's anything we can do to help you with the sale of your home or a purchase, please reach out. One of our associates or myself would be happy to help. Thank you so much.